Hello and welcome to Compass Global Markets Weekly Markets Update. I'm Tony Boyajian. We've seen safe haven trades prevail following the US missile attack in Syria and concerns that it could lead to wider conflict in the Middle East. The US has also moved a warship to the Korean Peninsula. We heard today that China has mobilized around about 150,000 troops at the North Korean border as well. It's about concerns about the unsettling behaviour there. We've seen oil prices firm around 4% over the past week. Talks between US President Donald Trump and Chinese President Xi Jinping has also supported the US dollar, as both presidents agreed to a new 100-day plan that will see trade talks take place that could boost US exports and help reduce the trade deficit with China. So risks of a trade war now between the two countries seem to have diminished. The US dollar has also strengthened now to 3-week highs after the US March non-farm payrolls, the jobs report that came out on Friday night. It was consistent with the US economy operating near full employment because the unemployment rate printed at 4.5% is the lowest level in a decade. And even though more people are entering the labour force in the US, it implies that there are more than enough hiring to absorb the demand. And we've also seen average hourly earnings in the US rise 2.7% as expected. The Fed's minutes have indicated an appropriateness to shrink the US 4.5 trillion balance sheet, perhaps later this year, especially if the US economy continues to grow at its current pace. It's effectively another form of tightening or raising interest rates. Overnight we saw Fed Chair Janet Yellen speak. She reiterated a gradual path when it comes to raising interest rates. She does not want to raise interest rates as rapidly as the market expects because she believes that policy is currently close to neutral. We've seen Dudley also mention a slight pause in the Fed's rate hike cycle, and Bullard also has spoken about the Fed's balance sheet. He backs this and supports the plan to shrink it, the balance sheet that is, this year. So we expect the US dollar to edge higher this week on encouraging US economic activity. Look, the US economy remains strong, that's the bottom line, and even though the Fed is likely to hike rates in June or September this year, it looks like sentiment continues to favour the US dollar. The only downside risk that we see to the US dollar going forward is any delays to President Donald Trump's tax reform plans, which will probably see the timing for their August deadline for have tax reform in place remain further on the back burner. And that is a likely weakness for the US dollar. Look, elsewhere we see in Europe the first round votes take place in the French elections on the 23rd of April. French centrist Emmanuel Macron is favoured to become the next president of France. Now he's facing a contest between the far right's Marine Le Pen and also the communist-backed left candidate Mélenchon. So we believe the ECB's accommodative monetary policy stance remains unchanged because inflation in the Eurozone remains subdued. The last reading was 0.7% and they've got a 2% threshold. Look, the Aussie dollar remains pressured on the downside. We've seen a fall of about 2.5% over the past week, and monetary divergence continues to favour the US dollar. We've seen iron ore price weaken a further 7% over the past week, since Friday in fact, and it's pushed the Aussie dollar below the 100-day moving average of 74.90, and the next level of support on the downside is 74.20. So good level for people who need to convert US dollars back to Aussie. Try and target that 74.20 level. Look, the next level of chart support, as we said, is 74.20, but the real big indicator for Australia will be Thursday's employment jobs data. We're expecting that to show like a 25,000 increase in employment, and if the unemployment rate can stay steady at 5.9%, we believe that could see the Aussie dollar move higher, back up towards that 76-cent level we were there last week. Now also on Thursday we've got some China trade data. We've got trade balance figures coming out. They're likely to move back to surplus. Around about a 35 billion number is the surplus forecast, and there's been a lift in Chinese exports that could also help the Aussie dollar strengthen later on this week. As expected, the RBA is on hold. We expect them to leave the cash rate unchanged at record lows of 1.5% for the rest of this year. It reinforces their neutral monetary policy stance, and of course they continue to favour the macroprudential regulations measures rather than tightening monetary policy. We've already seen APRA, the regulatory body, come out and reduce the proportion of interest-only loans from 40% to 30%. And the RBA's main concern now is that any future interest rate rises in Australia will have a larger impact on the economy than it has in the past. If we look at current market pricing, there's less than a 10% chance that the RBA will cut rates this year, but there's a 50% chance that they'll raise interest rates in the next 12 months. I'm Tony Boyajian, Compass Global Markets.